Hello, I'm Greg Bennell. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis, investment insights, help boost your trading potential. Coming up, investors remain focused on the conflict in the Middle East and the Fed's latest moves. Central Bank is still projecting 2 rate cuts this year, but with a more hawkish tone. What does it mean for stocks, bonds, and the road ahead? We're going to break it down with our guest, who also says a retest of the lows still on the table. He's going to share the key signals he's watching and what could trigger the next big move. Plus, gold's break it. We're going to dig into the charts to see where it could be headed next. That's all ahead. You're watching TD Active Trader Live. U.S. markets are closed today for the Juneteenth holiday, commemorating the end of slavery in the U.S., but we're going to show you some one-year charts. The S&P 500, it's an interesting look, not far from its all-time high of 6,147 hit back in February. That big swoon, we all lived through it in April. We knew what that was all about, but a big comeback as well. Be interesting to get Bill's thoughts. Bill Strazzullo, I'm spoiling the plot. He's going to join us in just a moment's time. Of course, we had the Fed yesterday before the market holiday, leaving rates unchanged, still seeing 2 cuts this year, forecasting increased inflation and reduced growth. Those are 2 things that usually don't go too well together. When we do get back to trading in the States tomorrow, we're going to have some companies reporting. CarMax, we told you about them earlier in the week, the used car retailer. You've seen revenue growth on demand for used vehicles, but is that demand holding up? We're also going to watch for details on their financing business, the appetite for credit in this environment. Interesting as well, tomorrow we're expecting Kroger results. This is the big U.S. grocer. What is the impact of tariffs on the grocers? Are they seeing inflationary pressures, and is consumer demand holding up? A lot of good questions when we get back to trading in the States tomorrow, and a lot of interesting names reporting. And that's your market update. All right, joining me now from London, Ontario is Hiran Amin, a familiar face on the show, one of our TD Direct Investing education specialists, and Bill Strazzullo, partner and chief market strategist with Bell Curve Trading, joining us from Boston. Great to have these guys with us. I'll preface this conversation by saying that any opinions, views, and forecasts expressed are solely those of Bill and his team at Bell Curve Trading, which have been substantiated by their research. All right, great to have you here. Bill, you have a strong track record of making market calls before the big moves. We've been through a volatile period. We're back near all-time highs for the S&P 500. What are the signals you're watching? What should investors be honed in on?
I think it's a good at this point, Greg, to take a step back and see where we've been. You know, coming into 2025, everybody thought that this was going to be a great year. You know, U.S. economy strong, labor market tight, Fed's easing, more pro-business administration coming in the White House. But at the end of 2024, we told our clients, and I talked about a number of different interviews, that we felt that the rally was tapped out. And definitely a contrarian call on, and we felt not only was the rally tapped out, but we felt that we were going to get a significant correction. And really the forecast was underpinned by the fact that the key trend driving the move higher, the rally off the March 2020 lows in the heat of the pandemic, which was turbocharged by historic monetary and fiscal stimulus, we felt that that was tapped out. And months in advance, we told our clients, look for 6,000 in the S&P, 22,000, 22,500 in the NASDAQ 100, and 45 to 46,000 in the Dow. And we hit it pretty much across the board. We had the big sell-off, a lot bigger than most people anticipated. And now we've had the bounce back. And so the key question is, where do we go from here? And I think people are lining up in 2 different camps. One camp is people want to wave the victory flag that, you know, the bearish price action is over and we're in a whole new bull market. You've got other people who feel that, you know, we haven't even seen the lows yet. And I think that misses kind of what we're going to see over the next several months, probably the bulk of the summer, which is more of a sideways range game. We put the lows back in April, which is simply a point where demand overwhelmed supply. We went low enough to bring buyers into the market. I think over the next couple of weeks, we're going to end up putting a high in off those April lows. And then I think, for the next several months, we probably go sideways. And I think that makes a lot of sense given all the uncertainty. Jay Powell talked about this yesterday in his press conference. He talked about elevated levels of uncertainty. What does he mean? We still don't know how the tariff policy is going to play out. I think Trump makes that out day in and day out. We still don't know what the tax bill is going to look like. We don't know with this Israel-Iran conflict, is there more legs here? Is it going to be another shoe that drops? And then we don't know how all those things are going to impact inflation, the economy, how the Fed will respond. And we're still just in the first inning of the Trump administration, which has been totally chaotic from day one with DOGE, the tariffs, and a blizzard of executive orders. So the bottom line here is there's a lot of the game that still hasn't been played. And so I think until we get more clarity on these major issues, we're probably going to go back and forth over the next several months. What does that look like? I think in the S&P, the upper end of the range is probably 6,200, 6,100. The lower end of the range is down around 5,200. And the Dow Jones, I think the upper end of the range over the next several months will be 44,000, the lower end 40,000. And in the NASDAQ 100, the upper end's probably 22,200, around the old highs, 22.5, down to 17,000. So I think there's going to be a lot of really good tactical trading opportunities on the long side and the short side. But I think from a directional standpoint, we're probably not going to make a lot of ground either way. And
let's get into those tactical opportunities. That's intriguing there, Bill. If you say we're range bound for a while now, obviously no shortage of headlines that can move the markets. If you're talking about tactical opportunities, what are you looking at?
I really want to play on the wide. I don't think this is going to be an easy game. Trading and investing is not like diving and figure skating in the Olympics. You don't get extra points for level of difficulty. So, you don't want to go in there and try to be the hero and buy the lows in any particular thing. I think you just keep it wide, and you don't play unless you're kind of at the extremes. And that's why I mapped out the ranges, because in between, there's going to be a lot of back and forth that I think is going to be very difficult to trade. But I think if you can stay disciplined, and stay on the outer edges of those ranges, you'll be fine. And then once we kind of get more clarity on all these really important topics and really important issues, then I think I don't think you can take anything off the table. I've talked about in interviews over the last several months that I think eventually the S&P ends up somewhere down around 4,500 to 4,100. The S&P, the NASDAQ 100, 16,000 to 14,500, and the Dow Jones 35,000 to 33. That would simply be a mean reversion retracement to fair value off the March 2020 lows. So I still, my bias is that we still haven't seen the lows, but I don't think that's the trade right now. I think over the next several months, it's going to be a back and forth range, and much more geared to tactical trading than it is people taking longer term directional positions.
All right, Bill, I'm going to jump in here as well, because you kind of mapped out the levels for us. And we're thinking about the equity. We're kind of in a risk-off environment right now. So even beyond equities, what are your thoughts on other asset classes like bonds, commodities, and even gold?
Bonds are, interesting. I'm not sure that, we've seen the highs in bond yields. When you go back and look at where we were in the election, tens and bonds, and where we are now, we really haven't made, a significant amount of progress in terms of higher yields. But that could definitely change, especially with this tax package and, how much we're going to add trillions, $3-4 trillion to the national debt. I mean, that could be, one of the factors that leads us back down to some of the levels I talked about before. So my thought on in terms of bond yields is we probably haven't seen the highs in bond yields yet. And gold, I think the key level for people watching right now is 3,500. 3,500 is the objective off the October 2023 lows, which was a major push higher. I'm a better seller in front of 3,500 in gold. If you said to me, what is a tell that the stock market's going to start to unravel? More than anything else, I think if gold starts to sit above 3,500, not for a day or a couple days, but you start to build value or sit above 3,500 for a week, that to me would be a major red flag that people are panicked and we're back in the mode where the equity market doesn't have a bottom. So I'm looking at, in gold, I'm looking at that level. I'm a better seller in front of it, but if we're able to hold above 3,500, then I think we're back, kind of in that mode that we were late March, early April, where, you see high VIX, you see major retracements in the equities. So I'm looking at gold kind of not only as something to trade, but also as a barometer of what the overall market looks like.
Bill, when you start talking about you're not ruling out the market's testing the lows again, what would be the trigger? I mean, is it just like pick something off of a list because there's enough things out there?
Yeah, that's a good question, Greg. The reason that we called the high, even before the tariff nonsense and Liberation Day fiasco and all that stuff, we called the high months in advance. I mean, back in the fall, we said, look, S&P is going to top out around 6,000, Nasdaq 100, 22,000, 22,500, Dow Jones 45, 46,000. That was based on the fact that the key long-term trend driving the move higher off the March 2020 lows, in our opinion, was tapped out. I mean, I've done hundreds of television interviews over the course of my career, and everybody comes on these shows and says they're a long-term investor. You want to stop an interview in its tracks? Ask them, what's the long term? Is it 3 years ago, 5 years ago? Is it going back to 1929? You need to know what is the key time frame driving the move higher. In our opinion, it's the rally off the March 2020 lows in the height of the pandemic when it became clear we were going to get historic monetary and fiscal stimulus. If you followed that trend, you stayed in the market for a long period of time. If you go back to 2023, 2024, we were probably the most bullish firm on Wall Street. But then once we hit our targets, we're very disciplined about getting out. And so the reason, Greg, I think that we may not have seen the lows is because that's still that long-term trend from the pandemic lows. March 2020 lows is still tapped out. We don't see anything right now that says that we should go much higher. Could we make nominal new highs? Sure. But I still think the bigger picture, longer term trend, the 5-year trend off the March 2020 lows is done. And typically when those big picture trends are over, what do? You mean revert to fair value. That's a fancy way of saying you pull back, you retrace to where the bulk of trading activity has taken place in those markets. And again, in the S&P, that would be 4,500 to 4,100. In the Nasdaq 100, it would be 16,000 to 14,500, and then in the Dow Jones, it would be 35,000 to 33,000. So the fact that we think we could still go lower is a function of the fact that the longer term trend off the March 2020 lows is tapped out.
Bill, let me jump in here because I want to just pin on those lows that you just talked about on the SPX. We've got the SPX chart pulled up. You're talking about 41 to 4,500. What's going to be the catalyst that's going to trigger these levels? Because these are pretty bearish levels that you have, probably more bearish than the general street even has. So what do you think are some of the key things that need to happen maybe in the second half that's going to trigger and get us into these lows?
Yeah, I think when we go through all the things that are on the table right now, I think the tariff policy is absolutely absurd. I think the risks far outweigh the rewards. I mean, look, Donald Trump's trying to onshore manufacturing jobs. Maybe in 3 years, 5 years, we have a new steel plant in Gary, Indiana that hires 500 people that makes a product that we can already buy cheaper somewhere else. But in the meantime, the impact on global trade, on our economy, on inflation is going to be catastrophic. And so as long as Trump goes down that road, then I think that's going to be a major problem. I think the tax package is a disaster in terms of what it's going to do. It's just going to add more to the national debt. We've seen this movie before. Go back to Trump 1.0. Part of the reason we rallied so aggressively off those April lows is because people said, okay, I think we have the tariff stuff under control. Let's go to dessert. What's dessert? Tax cuts and deregulation. But if you look at that during the first Trump administration, look at what happened. We had GDP in 2017 of 2.3%. Which is when we had the tax cuts. We had a spike in 2018 to 2.9%, and then back to 2.3%. And then, of course, 2020 was COVID. But my point is, even with the tax cuts and the deregulation during Trump 1.0, we couldn't even get the trend rate of GDP growth. Trend rate of GDP growth prior to the pandemic was 3.0%. So all the people out there are thinking, okay, we've kind of, the storm clouds have blown over. We kind of know what this tariff stuff is about. Now we're going to get the tax cuts and deregulation. The tax cuts and deregulation during Trump 1.0 couldn't even get us a trend rate of growth, and they just blew a bigger hole in the debt. So if that's what you're looking for, I don't see it. I really don't see it. I see a lot more potential headwinds than I do, good things going forward.
Bill, always great to get your insights. So great to catch up with you. Thanks for joining us today.
My pleasure.
That was Bill Strazzullo, partner and chief market strategist with Bell Curve Trading. Just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only, should not be considered investment advice or buy, sell, or hold recommendations. And if you at home have a question for our guest or our team, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. This will take you to our TD Active Trader Live website, where you can try out the TD Active Trader platform risk-free. You just open a practice account, you click on that Try TD Active Trader button. All right, Hiran, we heard a lot of interesting stuff there from Bill Strazzullo. He gave us a lot to chew on. A lot of stuff really stood out. I was intrigued by the fact that he said, even though we're near all-time highs, we could see a retracement back to the market lows. What really stood out for you?
Yeah, he talked about a lot of the headwinds and, the big, beautiful bill. That's obviously what he was referring to when he's talking about, more debt being issued. And, with his fair value gap that he mentioned and, kind of that's the zone where you want to look at. We still have quite a bit of downward pressure coming on the SPX, and I've got the NASDAQ pulled up right now, that we're going to see these headwinds. But, the thematic out of this, these headwinds are not going to go away in the next quarter or, in the next couple of months. They still got to work through a lot of those deals. We've got that deadline that's looming again, or the pause that's coming off again, and we're going to see what happens after that. And then you have this whole, the Middle East, which is just causing risk-off markets. So the end of summer or going into fall, when we might have rate cuts back on, might give a bit of a bolster. But I think we're still, as Bill mentioned, we're still in that range value right now with the indexes. We don't see a breakout potentially coming out here anytime soon.
Always intriguing thoughts from Bill and stuff for our audience to chew on, but a lot more show to come. Now, for a more technical take on what's happening in the markets, Hiran, what are you focusing on?
Yeah, we've got a couple things we wanted to just put through the roster, Greg. We're going to start with the Dixie, of course. DXY is the ticker symbol for the US dollar index that we have. It's been advancing a little bit overnight. We saw this green candle. I've got the weekly chart that's pulled up that we're looking at right now. And it's giving a distinct whiff of risk aversion amid the reports, or rumors right now over last night, or at least there's the strong rumors that the US is possibly planning to join the strike with Israel in Iran in the coming days. And that's really diminished the sort of appetite for risk-perceived assets. So the greenback does remain supported as this Middle East conflict does still continue on. And there's going to be increased demand for safe haven assets such as the US dollar. What we're also seeing is that the progression on any deals that the administration is trying to do, obviously they're preoccupied right now with the Middle East conflict. It doesn't seem to be like they're forging any sort of agreements with the key partners just yet with that pause happening there. So what I'm looking at with the charts, again, we've mapped out the key level here. 97.50 is kind of the floor right now that we've hit. We've seen this green candle on the weekly still close above it. This is the fair value zone, or the liquidity zone is where I'd like to see it. So we could see it break outside of this downtrend that we have and push back into the zone. It's a far cry right now before we see the US dollar recapture this key resistance at 104, which has kind of been respected, going on for a few months, where it's kind of hit, broken up, and supported, and it's become resistance again. So we've got some time to go on that, but we'll see. We should see some strength in the coming weeks on the greenback there.
All right, interesting work there on the dollar. What about, Bill gave us some nice ideas there on gold to mull over. You're taking a look at gold too. What's catching your eye?
Yeah, so gold trades in a tight channel right now, Greg. If you can look at the chart that we have, it's kind of in that 3,400 range. We've seen lower candles, or narrow body candles is what I should say. So kind of a little bit of indecision whenever you see these candles taking shape. We saw it modestly recover from those lows that it hit earlier, and then trying to break back to that key resistance, which is that 3450, which marks over here. It still is not the all-time high, which is that 3500 level there. This is going to be sort of the key level to watch for as well. We talked about this as being a risk-off environment and gold being really that supportive, traditional safe haven asset there. Again, it's all hinged on the conflict, and we're going to see a little bit more of an uptick in the coming days coming out of these. But right now, we've got 3365 as our near-term support, which is being respected over here quite a few weeks in a row over here. But this is the key level. Once it does get past this 3,500, if there's enough of a push to get there, we could see that clear sort of run for and a fresh trigger for bulls to come in again to take it even higher.
US dollar, gold. Now you got a company-specific name for us, MasterCard. There's a lot going on in the world. Doesn't seem like it's about MasterCard, but maybe it is.
Yeah, absolutely. So it's not directly tied, but I think they're kind of a proxy to what's been happening. And I'm going to just kind of do a quick refresher on what we just had passed through. So MasterCard, Visa, sort of these digital payment processors, they've had, they were down about 5%. You can see this significant big bearish candle. This was on the note just coming out of Tuesday. What had happened was legislation had passed for a bill known as the Genius Act across Senate. It took a while. This is supposed to be one of the easiest pro-crypto sort of legislation pieces that they're working through, but it did take a couple of goes to get it through, but they did get it past the finish line of the Senate. It now goes down to the House. But after that news broke, we saw this big sort of bearish candle emerge on MasterCard here. Now, this is all around the news. What is this Genius Act? Well, it's the use of stable coin-based systems that would allow essentially merchants to bypass traditional card payment rails that are in place right now. Now, stable coins are kind of the appetite and allows for regulation as well. It's pegged to real-world assets. 99% of stable coins, in fact, right now are tethered to the price of US dollar. Now, one of the studies that I just wanted to bring to our audience was Deutsche Bank found that stablecoin transaction hit $28 trillion last year. This surpasses both MasterCard and Visa's combined sort of payment processing. So it gives you a sense of why the market is getting a bit spooked about this. What we are seeing now is these key levels. MasterCard's hit this 540 key level. We could either see a bounce. I want to see confirmation closing, but the next level down is the 520 to keep an eye on. It's definitely broken off of this uptrend that we started off the April lows. It's kind of went sideways, choppy range, kind of tried to break that. It hit this all-time high, but it's obviously reversed quite off of those levels right now. So that will be the one to see for coming weeks and coming into earnings as well shortly.
Here, and you've done so much nice work on that MasterCard chart. It seems like a good opportunity for you to walk us through a couple of ways you could trade MasterCard. Before we get started, just want to remind our viewers that options trading carries high risk, may not suit all investors. Significant losses are possible. So it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. So walk us through it, here.
Let's talk options, Greg. All right, so I'm going to start with a bearish look on it. We want to give two views on what the charts are telling us. So I've in fact got it set up here. So I'm going to just switch my views. We're going to go to our, I said bullish trade, I hope. So we're going to start with the bullish one here to begin with. So the trade that you would consider possibly on a bullish side, and it's kind of neutral to bullish, is what we're looking, because we might see that reversal off of this level, recapture that 50-day moving average, possibly just get up to that 21-day moving average. So the trade I've got mapped out here is a credit call spread. So essentially what we're looking to do, we've got these levels mapped. We're looking to sell this 575. Now this represents this previous high on this on about earlier in the week here, so it has to break. It's also where the gap had formed. So from this close to this open on Monday, we saw this gap forming. So this is where the area lies where we want to recapture it and just stay outside of it. We're looking to buy a 10-point out call outside of it, which is the 585. This is going about a month out. On the cycle over here. Now, if I just bring up my options chain for a second over here, I've got this trade sort of mapped out and just give you the risk profile. So what we're essentially looking to do is we're going to see the stock, if it does reverse, we could see it recapture and go back towards capturing that resistance area right at that 575, but that's where we wanted to kind of take a pause, take a break, Greg, at least during our expiry. We don't want it to go any further, and this is when we'll capture the max gain. We're looking right now to get into the trade at least for a $3 credit, so it's not quite there yet just because of how far it's fallen. That's what we want to get just to give us a little bit of margin of safety here. And then, Greg, we talk about risks. What does it mean for us?
Always need to know the risk, my friend.
Absolutely. So here's where the risk is, and it's mapped out beautifully. So what we have is, you can see after we hit the 575 level, we are going to start having declining profit until we kind of hit our break-even point. The break-even is just going to take you're going to add the $3 premium that we're looking to get on top of the 575. So that 578 level is when we start losing money, but absolutely beyond 585, if it does push at that level by the expiry, then we'll stand to lose the difference between the spread. So it's $10 minus the 3. So in this case, we're losing $7. In other words, $700 on a single contract here.
All right. What if you have a different view of MasterCard? How could you possibly play that through an option strategy?
All right, let's go. I thought you never asked, Greg. Let's go to the bearish view, okay? So we're going to go to the bear trade here now. I'm going to have to just size up my chart a little bit here. So the bear trade that that one could consider is a calendar put spread. So what we're doing in this trade essentially is we're buying this, we're basically dealing with the same strike, but across different expiry dates. So what we're looking to do is go a little bit further out on the long purchase of the put. So we're looking to buy the 530 put for the 15th August cycle, which gives us roughly about like 60-ish days out. The reason we want to go further out on the long side is because we want to reduce the time decay that's there. And then on the short side, we're going near term or front month, and we're selling the 18 July 530 puts there. So the idea is that we expect, like, to break this level. If it does get down to this 530, we're looking for about, this is going to be a debit trade, I should say, Greg. So what that means, I've got it already queued up on the order entry over here. So we're looking to spend about $5 on this trade. And so essentially what we're looking to do is, we're looking to capture, we're not quite at the 530, but this marks a significant level. If it does break through that key level, then we could see further downward pressure at the 520 level and then down to the 500 level with the early sort of May lows over here. Now, I'm just going to show everyone what the risk profile looks like. So I'm just going to turn off our other one. We'll turn off this one. So in this trade, what you have essentially is you've got, like, coming to near term, we don't want it to get to 530 by our early expiry in July. So we want to capitalize. That's what helps reduce our cost. But beyond that, we do want that trade to kind of start compressing down below that 530 level going into the August print there. So this is what we're looking to stand at. We're spending the $5. The risk on this trade, Greg, is because it's a debit, it's always what you're going to pay. So in this case, we're paying the $5. So if it just doesn't go down at all, it kind of stays flat where it is, we'll be out the $5 closer to that expiry that we're holding out for.
Interesting stuff as always, and lots for the audience to think about here. And thanks so much for that.
My pleasure, Greg.
Here in Amin from our TD Direct Investing team, and of course, one of our key TD Active Trader Live panelists. Well, that is the show we got for you for this week. As always, investors should perform their own due diligence before engaging in trading. Thanks for watching.